Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today is Thursday. It's March 10th. I, for some reason, thought yesterday was Thursday. I was talking about the CPI report like it was coming out in an hour. I apologize for that. But today is Thursday. Now, as you can see here, the Dow and the S&P and the NASDAQ, they're down quite a bit, but consider the fact that the Dow went up over 800 points yesterday and the NASDAQ was up over 1,000 at one point. So this volatility, it looks like the market's down quite a bit, and it is down quite a bit. But if you look at the underlying scenario that we've been under and everything we've been under, it's not nearly as bad as it looks. We are in this volatility mode. Now, to give you some idea of what I want to see right now on the Dow, and these are important levels you need to pay attention to. Right now on the Dow, I don't want to see us breaking this low. The low here is 32,250. If we break this low, it's not going to be a good sign. There's a good chance we could stay above these levels. We actually took out the high of the previous day, which would make this into a double bottom, which would make this into an ascending trend, which means if we break out above the 342 level, we could be bullish. But right now, we've got to be really careful because we're in this scenario right here. This area, and we need to break outside of this area, hopefully break out to the upside of this area. I'm just going to leave this here for a few days, kind of like I left this here for more than a few days. Anyway, the point of the matter is I'm hoping this is the end of it, and the fact that we broke up above the high of the downside is a very positive sign. Looking at the QQQ, similarly, yeah, this thing was up 1,100 points, and it took down half of that. So again, we're opening down, but if we could remain above the 319 level, we'll be golden. I do believe we're going to be staying within this range for quite some time, though. Not quite some time, but maybe another week or two till we get all the gyrations and the war past us. The market has to assimilate, and it's hard to assimilate something that's completely unknown. So that's a major, major factor. In terms of Fed data, we've got the Consumer's Price Index today. It's happening in about 22 minutes. This report gives us a very good indication of how consumer prices have been over the last several weeks. And in this case, the month-to-month we're looking at is 0.7%. 0.5 is on the low end, 0.9 is on the high end. We're looking for middle of the road. I would be more concerned with looking at the year-to-year numbers. They're a lot less noisier, and we're looking for 7.9. Again, if the numbers are weaker, it's telling us inflation is not as strong, and if the numbers are higher, it's telling us it's really strong. Now, I want you to keep in mind, these are food prices. 7.9% food prices have gone up year over year. Can you imagine that? That's nuts. And ex-food and energy, 6.4%. But think about this, 7.9%. That's almost 8% you're paying higher for meat, poultry, milk, and so forth. So it'll be interesting to see this number. Jobless claims I'm not too worried about because honestly, most of the impact that we're seeing right now is because of the attack in Ukraine. Now, a few other things for you, and this should be positive for the stock market. Even though we went higher yesterday, the put-to-call ratio went to 1.14. That's very, 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 very high. And that's telling us the markets need to go higher, not lower. That means there's just way too many put buyers right now in the market. And that means when typically you have so many put buyers, call buyers come in. Now, typically when we're near the 90, the 1 area, it's significant. But when we get to the 114, that's telling us that the market is grossly oversold and needs to go higher. So that's very positive. That's a very, very bullish sign. Another bullish sign is the Volatility Index. Now, volatility is a little up yesterday, but we are still below the 3.7 high, which was made 3 days ago. That's very significant that even though the market has gone down since that time, we have not been able to break the 36-35 level. And if volatility keeps going lower, that's also a very, very bullish sign for the market. And another bullish sign for the market is, and I've explained this many, many times, and I'll show this again to you guys because this is very significant. We can't run away from momentum levels. And if you look at the NASDAQ momentum levels, you will see that literally we're right at the cusp. So we can go just a little bit lower, break a little bit lower and start coming up, or we can start coming up from here. But the bottom line is this is COVID. This is 2018 rate hikes. again, 20 years, we don't break these levels very often. And if we do, it's not for a very long time. So I'm not expecting a significant breakdown from the current level. I'm more looking at buying opportunities at these levels than not. If you're looking at the major sectors right now, we have energy, utilities, consumer staples, and healthcare. I would stick right now, if you're looking for anything more than a 2 or 3 day flip, these are the sectors you want to take a look at. Nothing good will happen until technology and consumer discretionary start going higher. This is a very, very, very defensive market. Like, this is a classic defensive market. And utilities have actually been coming up because energy prices locally have been hit so hard, right? We're paying so much more for utilities, which is natural gas, and all of the other good stuff. Now, in terms of stocks, the stocks that are still moving higher right now, you still have energy, basic materials. This is phosphate. They make materials that solar-powered batteries and cell phones uses. Industrial stocks, energy stocks, energy stocks, energy stocks, energy stocks, energy stocks. You guys are seeing a pattern here, energy stocks. If you go a little bit lower, you start seeing a little copper stock, gold stock, EOG Resources here, FMC, Dollar Trees up here, Williams, Marathon Petroleum. Again, it's got a few stocks that are not energy related, but for the most part, you could see a theme here. The theme is very, very straight, energy. And if you look at the lower end of the things, you could see here that all of the stocks, I'm not kidding, Bed Bath & Beyond, Under Armour, Adobe, Autodesk, Netflix, Under Armour, PayPal, Moderna, these stocks were all all-time highs a year ago. These were right at the higher end of the scale. So till we start seeing consumer discretionary stocks come back up, and they're not coming up right now, we're not going to see any soup for any of those assets. Now, to give you some levels, and I guess I'm really liking this right now, to give you some. Sorry if you hear meowing. I got a cat back there who desperately figured out he needs to leave this room right now. He can't wait another 5 minutes. We're going to make him wait. So if you look at the S&P, let me just give you some more levels here. Yeah, if you look at the S&P, we're still in this gyration. And again, we're going to stay here. I'm hoping that today, by the end of the day, we can break above the 430 level. If we can break above the 430 level, we will be golden. On the QQQ, that level, let me go ahead and give you that level. On the QQQ, that level we need to break is 337. And I'm hoping we'll break that level before the end of this week. If that's the case, then this will signify a double bottom, and we will be in a much, much better position to build a base and go back to the 200-day moving average. Right now, again, Ukraine war and Russia is the biggest factor, and then we have a little Fed data. But today's Thursday, so I want to give you guys an ETF. My top ETF right now is Commodity Index Fund, DBC. It hit the 20-day moving average. It's right now going like gyrating. If you're looking for an option on this, there is a option. I would go all the way to July, and I would go to the 26 strike price. You can get this sucker for less than $3. 25, 26 strike price. Not bad. If commodities and inflation keep hitting us in the you-know-where, this thing was going to continue rising or staying near the current area. It's already up 0.46 before the day even started, 0.1.78%, 1.93%. It's moving too fast. The point is, it's over 1.5% pre-opening bell. Now, before I let you guys go, I've got something important for you, something I really think you should take a look at. Now, I've coded an algorithm. This algorithm is designed to capitalize in any market conditions. Bull market, choppy market, bear market. I've got you covered. It even has a super cool hedge. It isolates the top stocks on Wall Street, which I call super stocks. That's right, super stocks. I even wore a Superman t-shirt for the presentation. All I have to do is flip a switch on my algo and get a brand new batch of trades. Oh yeah, it's like that. And I want to make sure everyone can get in on these opportunities. So I'm inviting people to join me and other traders already capitalizing on these super stocks right now. Click on the link below this video, especially if you're watching on YouTube Wealth Press channel, and check out my super stocks algorithmic strategy at work. What I love about this video, I'm not going to try to sell you something. Well, maybe in the end, but I'm going to show you 4 factors that take the S&P from like 600 something percent return to over 6,000% return. 600% return to over 6,000%. 4 factors, and I'll lay them out so you can apply them in your own trading if you want to. So there's no catch, no monkey business. Follow the link below. Check out Superstock Algorithmic Trading Strategy right now. Tomorrow we're going to talk about my weekly recap, biggest winners, biggest losers, what to expect the following week. Follow the link. Check out Superstocks. Bye, guys. Have a great Thursday. Send me some emails, support@marketgeeks.com. Have a great day and have some exposure to commodities. It's the smart thing to do. Bye.